Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 9th of May, another 4-day trading week in the UK as a result of the Coronation Bank holiday. In terms of global markets, the volatility remains enough to just about nudge the Dow Jones index in the States into negative territory for the year. The Fed, much as expected, raised interest rates by another 0.25%, although the hopes are very much that that is the end of the rate hiking cycle for now. That being said, of course, attention now turns to the cumulative impact of what the Fed rate rises will do to the US economy, and should the US economy go into recession, how deep that might be. There is still some in the market hoping that we might actually be seeing interest rate cuts before the end of the year, but that's not in the Fed's playbook at the current time. On top of that, of course, there is still some turmoil in terms of US regional banks. That's taken something of a shine off of sentiment, even though the larger banks still seem to be fairly robust and somewhat isolated from what's going on there. So the result of that is that in the year to date, the Dow Jones is now down by just 0.1%. However, the other main indices in the States are still in comfortably positive territory. The S&P 500 up 5.8%, Nasdaq up 14.3%. In terms of the FTSE 100 in the UK, also ahead by about 3.8%. Turning to next week, it's a slightly lighter corporate calendar, but there are some stocks worth looking out for. The first of those is Rolls-Royce, who are due to release a trading statement. Obviously, a lot of Rolls-Royce income comes from flying hours when airlines are flying and they're basically using the engines that Rolls-Royce has made. As we've been seeing from airlines, we're getting back to pre-pandemic sort of levels of demand and indeed capacity. And indeed, Rolls-Royce is currently anticipating that they're back to about 80 to 90% of pre-pandemic flying hours. At the same time, they're looking to bear down on costs and their general efficiency because, again, similar to the airlines, one of the outcomes from the pandemic was that they needed to borrow a great deal of money to shore up the finances, and so they need to be working on their current debt pile of around £3.3 billion. The shares have bounced very strongly over the last year, up about 79%, although to put that into perspective, if you were to take a 5-year view, the shares are still down by 48%. Also, first quarter numbers due next week from ITV. A couple of things to look out for here. Shares have just about nudged into positive territory, up 3% over the last year or so. The announcement that it would be launching a new streaming service, ITVX, was not taken that well at the time, particularly given the strength of competition elsewhere. So it'll be interesting to see how that's faring. And the other headline things to look out for is the ongoing attempt by the business to replace advertising income, which could be under pressure given the current economic climate, with some of the income from its studios business. So they're the main points there. Finally, ASOS, as seen on screen. Half-year numbers due, another retailer which really has been under the cosh. The shares are down by 50% over the last year. Very much a question of profits and cash flow under pressure. So let's see whether the new chief has been able to stem some of those losses. Retail, of course, on the whole at the moment, with the exception of one or two, has very much been seeing the outcome and the impact of a cost-pressured consumer. So the other thing, of course, overhanging these shares, it has become something of a target for short sellers, which is adding to that downward share price momentum. Thank you for watching. Have a great week.